2020 is actually a special year for the market because it's had the most IPOs and SPACs yet to date. It is very exciting for a lot of investors out there, especially with the millennial investor wave coming through the market, that all these companies, they are all related to artificial intelligence. They're all related to convenience like Doordash and Airbnb. So all these millennial companies are starting to roll into the market as the millennial investor is doing so as well. So you're seeing these companies go into massive new highs, and they're continuing to shoot up because the millennial investor is buying them up quickly. It's very attractive for the millennial investor to purchase a stock that he is or she is familiar with. So it's an absolute phenomenon that we're seeing this happen. In terms of Airbnb and Doordash, both stocks freshly IPO'd. A lot of people are asking, is it the right time to buy? When it comes to my philosophy, which I'm going to share with you guys later in this video about purchasing new IPOs, I would say it's a little bit better to wait. But how long is the waiting period? That's something that we're going to get into when we move into the chart. But first, let's talk a little bit about the companies and how they've hurt over the few months or the year that coronavirus has happened. DoorDash has actually seen a massive influx of new customers. They're seeing a lot of new users, and their CEO and analysts are projecting that coronavirus just supercharged what's coming for this company. So there's going to be a lot more to come because of COVID supercharging all these new users into their app or company. In terms of Airbnb, Airbnb was actually a company that hurt. They saw their revenue actually slip through COVID. However, they have proven themselves to be a valuable company prior to this, and they are likely going to continue that trend as soon as they're able to get back into normal era, into the new world in which we're going to be COVID free, hopefully within the next few years. So Airbnb is one not to worry about, in my humble opinion. I think overall from their numbers, they are continuing to be a valuable company, and their stock right now may be a little volatile, but over the years I do believe in them long time. Now, if we talk a little bit about the valuation, we can see that Airbnb has actually been growing year over year in terms of revenue. So when looking at Airbnb's number, we can see that they are actually growing year over year. When we compare 2017 to 2019, we can see that revenue has nearly doubled. And when looking at another thing, we have to look at their balance sheet. Their current assets at 6.6 billion as of 2019. And their current liabilities is at 5.2 billion. So we want to look at both liabilities and assets because a company's assets should be growing. They should not have too much liability going on. And we also want companies with good amount of cash flow. Cash flow is not too bad for Airbnb, but I would like to see it start to move in the right direction, especially that 2020 was a big hit for them considering COVID did drop their revenue a little bit. So the reason why companies would need cash flow in their balance sheet is because of situations like COVID or any black swan events that may require them to pull money out of their cash flow and fill the gap for whatever case may be going on for the time being. So I would like to see cash flow grow over the years, but over the big picture, Airbnb does look like it's moving in the right direction, and we really will be the judge of that after COVID passes. So when it comes to Doordash, and it's very important that you don't do this, you don't want to compare Doordash's balance sheet with Airbnb's balance sheet, because then you are now talking about two different sectors and the companies operate in different sectors. So you want to compare Doordash with perhaps Grubhub is going to be more of the right comparison. But in terms of Doordash in specific, we can see that they are also growing. Their assets are growing and their liabilities are healthily growing as well. So we're not seeing too much debt on the stock. And let's see, they have cash flow. They have plenty of cash flow as well. So overall, both companies are growing and they're moving in the right direction. Now, in terms of purchasing the actual stock, my personal philosophy has always been to wait at least 20 days to 50 days before purchasing. And here's the reason why. If we look at Palantir, we can see that the stock has risen up significantly since their IPO date, but I like to wait those 20 days because of these lines right over here. So this is the 10, this is the 20, and this is the 50-day moving average. And you can see that the 50-day moving average is actually just beginning to form as the stock heads into its 50th day on the market. And the 20-day moving average formed a little bit after the stock IPO'd. The reason why I wait 20 to 50 days is because of these moving averages right over here. So we know from the 10, 20, and 50 day, if we look at the 20-day moving average, we know that over the last 20 days, $23.39 has been the average price for PLTR. And when comparing to the 10-day moving average, we know that 26 has been the price for that specific moving average. And those moving averages will now act as natural supports if the stock is trading above them, and they will act as resistance points if the stock is trading below them. The reason why this is important is because we have a better understanding of where traders are finding a sweet spot of a price over the last 20 days rather than moving into a stock that has just IPO'd into the market, such as Airbnb. We can see that Airbnb, we don't have any moving averages. Yes, we have moving averages within the 5-minute charts. We have moving averages within the 1 hour, not even in the 1 hour charts, but we don't have them on those daily candles. And here's how risky it is to purchase a stock at a fresh IPO. Airbnb IPO'd at 100 and reached a high of $165 at one point, and then today it fell to $135 because there is no sweet spot for the price just yet. So you always want to give the stock a little bit of time. Yes, it hurts sometimes to miss out on those big runners that actually end up taking off, but at the same time, the risk that you're taking by purchasing a fresh IPO, especially one like Airbnb or another one like Doordash, you're not going to miss out on much if you avoid the risk, because if you keep taking these risks, you're actually going to end up in the red, because most of the time it goes against you than it goes for you, especially with how big these IPOs are. So what do we do in 20 days? What do we do in 50 days? We look back at the daily chart and we see where the natural price has been flowing through the last 20 days. And if we don't have an exact price just yet, then we wait for that 50-day moving average to form. This is what these 20-day and 50-day moving averages do for you. They allow you to see where the health of the stock is. Obviously, a stock trading this high away from its 50-day moving average needs a correction, and it corrects itself back down. And that's what these moving averages will end up doing for you if you just wait for them to form on these fresh IPOs. Anyways, you guys, I hope you guys enjoyed this video. If you did, please give us a thumbs up. If you want to see more, subscribe to our channel. Thanks for checking in.